We're going to talk about adjusting entries first in terms of deferred expenses. I'm going to break this video up actually on the deferral of expenses into two videos because there are really two kind of distinct concepts that come into play here. So I will split them up to hopefully make them a bit more focused. So when we talk about deferred expenses, those are really things, it's just a fancy way of saying those are things that we prepaid. I think the example that we've used previously in these chapters is prepaid insurance. Now, when we have prepaid that insurance, at the time that we recorded the event, we recorded a debit for an asset of prepaid insurance. And we were then recorded the cash, which was a credit. The cash went out. So now we've reached the end of the accounting period, and we're going to, and we'll talk about insurance as the maybe most obvious example. We could also be looking at rent, supplies, but insurance might be the example most relevant to your own life experience. So we paid for this year, 2 years, whatever, of insurance, and we're now through the first month. We've earned some of that insurance. If we canceled the policy right now, they would not refund the entire policy back to us, only the unused portion. So now we want to make an adjustment to show that we've incurred the insurance expense for that month's worth of insurance that we just used up. So the way that we do that is we take that prepaid insurance account, and that had a debit balance in it when we first paid the money, but now we're going to record a credit just for the month that we've just used up. And at the same time, in that same amount, we're going to go over to the expense, the insurance expense or whatever expense we're dealing with, and we're going to record a debit that now shows that we've incurred an expense for that time period's worth of insurance. And so looking at this in a more concrete example, we've got Fast Forward that paid $2,400 to cover insurance for 24 months, and that began on December 1st. So 24 months, $2,400, that's going to be $100 a month for insurance. When we first record the payment for that prepaid insurance, it's a debit to prepaid insurance. And I just said that, let me just move myself. But now here we are at the end of December, and what they didn't also show you was the credit to cash on the last slide that went with the debit to the prepaid insurance. But anyway, so at the end of December, we should only have $2,300 left in the prepaid insurance account because we just used a month's worth of insurance during December. So we're going to credit that prepaid insurance account for $100 and then debit the insurance expense account also for $100. This leaves the balance now in the prepaid insurance account $2,300. And we will continue to do that month after month until we have used up all $2,400 of that insurance. And I'm going to pause this because I have to sneeze. Okay. And so you will see we are now left with a $2,300 debit balance in our prepaid insurance account as a result of the month of December having gone by. And we will now, for the month of December, show that we had an insurance expense of $100. And I showed it to you in T account form, but in terms of journal entry format, which is, I should say general journal, we've got the debit, which appears first for the insurance expense, and then the credit to the prepaid insurance, because again, debits always come first, credits always come last. Now we're going to apply this concept as it relates to supplies. So fast forward, purchased $9,720 of supplies in December. We used some of them in December, but we still have some left over. So we go out, we count how much we still have left in supplies, and we see that we still have supplies we haven't used of $8,670. So the balance in our supplies account when we had purchased that was $9,720. And again, we had a credit to cash in that amount as well. But now here we are on December 31st, and we're going to make the adjustment because we need to bring the balance in the supplies account down to what we really still have on hand and show that we used up $1,050 in supplies. So by crediting the supplies account, it shows that all we have left is $8,670, and then we have this supplies account for $1,050 that will get a debit. Oops. And now let's look at this not in T account form, but in the way that it would actually look in terms of the journal entries. Here we go. So again, debits first, which would be the supplies expense, followed by credits, which is the credit to the supplies account to record the supplies used during the month of December. And I'm actually going to stop this video here, and I'm going to go on to a new video to talk specifically about depreciation, because this is kind of a whole other animal of treatment of expenses.